Can you explain your option on F? I have no idea how much they cost or how you calculate profit with it. Yeah, briefly. So I bought a January 21st, 2022 17 strike option, right? And I bought this when the stock was trading at 1650s or 1660s. It was like around here. I bought it on the low, right around the low of this day. So I bought a strike price that was $17. So what? So at its core, what an option does, what a call option does, is it allows you to buy the stock at the strike price. I was gonna say on the day it expires, but that's actually not true. You can exercise early, so it allows you to buy the stock at the strike price. So when Ford was trading at around 16.5, 16.6, I took a 17 strike option. That gives me the opportunity. To buy the stock at $17. But it doesn't expire until the 21st of January next year, right? Now the stock price is up to 18.22 this morning. So that obviously I have intrinsic value of $1.20 on the option, right? So this intrinsically is worth $1.20. It's gonna be worth a lot more than $1.20 because it doesn't expire until 21st of January, right? So there's things that get baked in. Theta is baked in. Theta is how much you lose every day. So currently I'm only losing $1 every day because it's so far out. But that's showing you that there is price baked into the stock because of how far away its expiration is. Just giving the stock room, giving the option pricing in the possibility of the stock having more upside before the 21st of January comes. Also, let me say this, because I know I've talked a lot about the option to buy the stock. I'm not going to buy the stock, right? I'm not going to go buy Ford at 17. That's not what I'm doing. That's not what 99% of option traders, I just made that up, but like I've actually never seen anybody do it, exercise their option, right? I'm just trading the premium. I will sell this option. Like I can just go in and sell this option for whatever it's worth. So I bought it at 110. It closed yesterday at 182 or 177 on the bid. So I'm up $67 on the option. Also, I didn't explain that. 110 is $110. A buck 77 is $177. You always move the decimal point over 2 decimal spots to the right to determine the actual price of an option, right? Because it's times 100, because it's 100 shares. Each option's 100 shares, so you move it over twice. But anyway, I'm up $67 currently, and options don't move in pre-market. Options don't trade pre-market. So this move hasn't been added to the price yet. So it'll open even higher this morning. When I look at the options chain, what the hell am I supposed to be clicking? It depends. So when you open your options chain on Ford, what these are all different expiration dates, right? These are all, so you can buy weeklies that expire in 3 days if you really, really want to. Notice how cheap these are, right? If you go on a weekly that expires in 3 days, look at how much cheaper they are. These are trading at $19 each. But it's because they expire in 3 days, right? There's less time volatility baked in. There's only 3 days worth of time in this thing. So it's riskier because you have less time for it to get up here on your calls. So by the way, also as I open this chain, left side is calls, meaning you're getting the opportunity to buy 100 shares of the underlying at your price if they are in the money. Puts means you get the opportunity to sell 100 shares at a strike price once you're in the money. So puts, you make money if it goes down. Calls, you make money if it goes up. So yeah, I mean, I when I swing trade options, I go at least 2 months out. That's why I went to January. But at that point, you're starting to talk about strategies, right? Which is not the point of this conversation yet. But I always go 2 months out. That's why I went to January, and I always buy at the money. So like I said, I bought it at 16.5. So I typically just buy like the next option that's out of the money. So when I longed it, 17 was the next one that was out of the money. That's why I bought that one. In the money is blue. Yep. Right, because the underlying is trading at 18.21. So on the call side, anything below 18 is in the money. On the put side, anything above 18 is in the money, because puts are down, calls are up, right? Any other questions? Hopefully I explained that okay. I'm trying to like Eli 5 this too. Like, I'm not trying to dive into too much. There's a lot more we can dive into, like all of this shit, gamma, theta, vega, delta. I know what all this means, but we can talk about that in a second. I want to make sure there's like the elementary understanding first. Like, I was going to say you don't need to worry about this stuff. You do need to worry about this stuff. But for your conversation level, hey, do you understand what options are? You don't